So good afternoon, everyone. It's fantastic to see you here today. And I hope that you've been keeping well in the past couple of months that we haven't seen each other. It's a full house today. We have up to 100 bookings, so it should be a good session. To those of you who are our usual guest, obviously, you know that this is the last session of 2020. We're very sorry that we haven't been able to turn back to the normal physical tax club. Hopefully, we'll be able to do that sometime next year. We know that it's not the same when you sit in the same room as people and then we have all the interaction, all the chat, but hopefully we'll be able to do that sometime next year. To our new guest, I noticed that we have a few newcomers this time. So welcome to DTE Tax Club. This is the tax session that we do every quarter, about 4 to 5 sessions a year. And we hope that you will enjoy today's session. As usual, if you have any questions, please pop them in the Q&A box below and speakers will answer them for you. So without further ado, I will hand over to Alan.
Thank you, Ella. Hi there, everybody. As Ella says, we've got a good turnout for today's session. We're very fortunate that we've got not only my definitely non-related VAT speaker, Rob McCann. He's going to do a topical VAT update for about 20 minutes, he tells me. We've also we've got Zoe from Croner, who's going to give us a bit of an update, a topical compliance activity update. And fourthly, we've got Jason from NORI HR, who's going to give some thoughts on IR35. So without further ado, I just want to do a few topical items with you guys. Now, first item, working from home. I used to laugh when people would talk about claiming disallowance for working from home, and I laughed until I qualified for it. And as a result of that, I have to now say everybody should claim it. You have two routes in which you can do it. If you are an employee of an organization, maybe you can convince the directors to pay it to you. We're talking of a figure here of £6 per week. And it's basically paid where if the employer has asked staff to work at home because of COVID-19, then they effectively have these additional household expenses. The employees can only claim if the employer has asked them to work from home for all or part of the week. So bear that in mind. If the employer won't pay it, then you can seek the relief of HMRC. And I believe you can apply online and it's just at gov.uk. So just have a look at that and see what you can claim. If you're self-employed, to a large degree, you presumably have historically maybe even claimed some allowance through your business account. If you've closed the office and you can determine what is a fair and reasonable cost for working at home, then when you do your annual accounts, give that some thought. Okay. Now, one thing that I'm finding across my weekly, monthly workload is accountants, tax practitioners contacting me and saying, hey, Al, one of our clients is disposing of a property. What's this new rule about paying the capital gains tax? Well, the rule is that within 30 days of the date of disposal, be a transfer within family or be it a physical disposal, you have a requirement to submit a capital gains tax return and pay any tax due. Now, in the obvious circumstance where it's principal private residence, no capital gains tax will arise. But there may be circumstances where there was a period where the property may have been the principal private residence and was then let, or it may just have been a furnished holiday let or whatever. But from a practical point of view, it is important that you explain to clients if they are going to dispose of a residential property, they should be telling you sooner rather than later, not as I am finding clients telling their accountant maybe 2 weeks after the event that they've got 14 days in which to do the return. Why? Because it takes time to do this. Some of the computations that people have asked me to look over, review, or comment on are quite complex, and they say, they'll contact me maybe only 4 working days before the deadline through no fault of their own, saying, is this comp okay, Al? Is there any tax to pay? Do you agree it? We've got to get back to get the return done. Now, the returns have to be done online. And what I want to just read through to you here, and I apologize for the little bit of length on this, but this is something I came across last week, which I can share verbally with you, but unfortunately I couldn't email you a copy. And it's called the UK Property Return checklist. So the obvious point 1, what is the address of the property? Is the individual an existing client, or do they need to be engaged? Because solicitors may contact you and say, can you help this person out? Obviously, if they're not an existing client, you've got to go through all the letter of engagement and everything. You then need to know, is the client registered for HMRC's government gateway? Because you have to submit the return through that. You then need to get postcode for login. Then you've got the question, is it 100% owned by the person who's asked you to do the return? Because if not, each individual has to do their own return. So help us flipping heck if there was 3 people owning this property and it was disposed, the 3 returns would be done. It's not per property, it's per registered individual. You need to determine what dates the contracts were signed as opposed to the date of disposal. You need to know the date of completion. You need to understand what's actually triggered this disposal. Is it a gift? Is it a sale? You need to determine the actual or deemed proceeds. You need to obviously, and this is what takes time, my friends, then obtaining details of the costs at the time of the disposal. How was the property acquired? Was it inherited? We all know if it's inherited, the client won't have told you about what the base cost was. So you're going to have to ask him to contact previous solicitors or whoever. You need to also add to that details of any costs of acquiring it. Were there any enhancements? I've recently done a calculation for someone, one of my own clients, where she keeps exceptionally good records, and she gave me a very detailed listing of all of the enhancements to the property. But I then gave her the $6 million question, which was, have any of these costs been claimed as a revenue deduction? Didn't do her tax returns back in the day when it was acquired. Her previous accountant may have been a little bit too generous in some of the revenue expenses that have been claimed against rent. So we have to look at that, particularly to ensure there's no double claims. You also need to consider, are there any losses that have been incurred or brought forward that have been put on the tax return? That in itself is a pet topic of mine. Every year, if I see a client face to face or know them well, I will always say, have you sold anything? And they say, no. Oh, but I made some losses on some investment. We should ask clients every year for that information. And when we ask for that information, why are we asking? It's so you can put the losses on the tax return and carry them forward. As you know, capital gains losses can be carried forward. I don't know what practices within your individual firms. When I take on a new client, I always say, can you give me an analysis of losses that have been brought forward? And inevitably, someone will say back to me, oh, yes, these losses, we put them on the 2016-17 tax return, but we didn't carry them forward. It's worth picking these up, getting them on the returns, so that when something like a disposal of a residential property comes along, you can incorporate those losses. Don't forget there's the annual exemption as well. And when you've finally got to that, you need to know what the client's estimated income is for the year, because you need to determine what rate of capital gains tax will be applicable. So that checklist, albeit I've run through it very quickly, is important that you if you're asked to do this computation, you get it as accurate as you can at first opportunity. But please, one thing to bear in mind, if you're up against it from a time point of view, please don't over-egg the deductions or losses if you've not got the information in front of you. I would make a recommendation that if you, on a generous basis, calculate the tax due, I don't know, is £25,000, but maybe you haven't got all that information, and as a result of that, the tax due could be as low as 20. Please, I would suggest you tell the client, let's pay the 25 on account. Why? Because you can adjust the return through the online portal. If then at a later date you get the information more accurate, you can always reduce the figure and you get the tax back. And finally, don't forget, with regards to these properties, there is still a requirement to put it on the relevant SA return if an SA return is applicable. And I'm guessing, and I think I'm right to guess, if there was a final fine tuning of those figures when you do the return, you would put the final version on there, and any tax that's been paid on account would be brought in and potentially would create a further refund or possibly an additional tax bill. It is an evolving thing. It's been with us now for what, 9-10 months, but please make clients aware, if indeed you want to offer this service, make clients aware that they can't come to you 1 week before the 30 days is up. Getting that in on time will be difficult, if in fact probably nigh impossible. If it is goes in late, potentially the penalty regime that goes with that, which I'm not really going to go in today because I've not seen any actually in place. So just take all that on board. What I'd like to do now is, I think I'll pass over to Zoe. Are you there, Zoe? And if Ella can bring Zoe into the fold. Zoe is with Croner's, and as I said earlier, she's just going to give us hopefully 20 minutes, my friend, on a topical compliance activity of what's going on there and what's actually going to go on. One area I'm really keen to hear about is about Airbnb, which is a bit alien to me in the real world, but I understand is an activity that a lot of people are involved in. So over to you, Zoe.
Hi, everybody. Yeah, so I'm a tax inquiry consultant at Croner Taxwise, who you may or may not know of the fee protection providers. We have a team of tax advisors and tax consultants, and I primarily deal with the tax inquiry side of things. I've been there for about 1.5 years. So I'm going to be giving an update on what HMRC are looking at presently, and where the direct tax compliance activity currently stands. And leading into that, I thought I'd just give an overview on the Public Accounts Committee meeting in September, when HMRC were challenged about tackling the tax gap, because this leads nicely onto the other areas that I want to talk about. Jim Hara, the Chief Executive, and Penny Sinovich, the Director General of Customer Compliance, explained how and why they are targeting the self-employed. They say small businesses are attributable to 43% of the tax gap in 2018-19, and increasing self-employment is a problem. So there's an increase of people into the self-assessment system, not only because of self-employment, but also because of property income and the higher income benefit charge. The self-assessment system does provide more scope for error than and non-compliance than the pay-as-you-earn system. So HMRC need to focus on helping the self-employed get things right and avoid the opportunities for making a mistake. They also need to tackle the hidden economy, as work in this area doesn't provide significant results for closing the tax gap. the traditional approach to self-employment resources is labour intensive, and it takes 4 times more resource in HMRC than administering the pay-as-you-earn system. So rather than asking for more resource to do things in the traditional way, HMRC are having to look at new strategic ways of working involving less resource to identify the risk and facilitate the self-employed to get things right. So making tax digital and simplifying the self-assessment process will help towards achieving and closing the tax gap. One of the compliance shifts now is the use, you've probably heard of one-to-many letters, nicknamed nudge letters. We've all heard about the letters in connection with the Worldwide Disclosure Campaign. More recently, they're using them to tackle compliance on the COVID grant schemes. The letters require self-correction by the taxpayer or disclosures using the digital disclosure facilities, and where individuals or businesses don't respond, HMRC will carry out further in-depth compliance activity. So the letters focus on, some of the letters focus on education rather than suggesting the person's done something wrong, but nonetheless they are targeted, they're risk-based targeted, and what I'll do in a moment is give you a quick overview on the current or some of the current campaigns in the one-to-many, using the one-to-many letters. But also mentioned in the Public Accounts Committee, HMRC are looking at agent conduct and poor standards. They want to understand the behaviour of agents and are carrying out investigations into some of them. I don't know if anybody's encountered that before. I've spoken to one accountant in the last few months who had a letter from HMRC. They are looking at those accountants with a high proportion of repayment claims or expenses.
Zoe, it's Alan here. Can I just interrupt?
Yeah.
I've had a fair bit of experience over the last year or two of that, and you're absolutely right. They take a view of accountancy practices that have a high percentage of their cases where they are claiming refunds as a result of CIS or whatever, and they don't fit in with their percentage model that they are looking. And I even attended a meeting where 2 lovely tax ladies came up from all the way from South Wales to East Lancashire, and you know, they're quite thorough in what they do. So yeah, people should be careful if they're, how can I put it, if they've been a little bit too generous on the old travel and subsistence and what have you. Be careful, because it is something that can get challenged.
Yeah, yeah. And they're easy targets as well. They've got HMRC have a system called Truce, which
no, they don't.
risks assessed for and looks at the repayment claims. That covers the VAT pre-creds and the direct tax repayment claims. So they're not. What they're doing is they're looking at the processes used generally by the accountant that they've selected, and they're looking, you know, to make sure that the accountant carries out appropriate checks and due diligence in general. But then they're asking for specific details of clients' returns, so they'll identify which clients they want to look at and ask for information voluntarily. Obviously agents are uneasy about this. So what I advised this particular accountant to do was discuss with the clients that HMRC had selected the request for information and evaluate the pros and cons as to whether they want to cooperate or not at that stage, or risk having a formal inquiry opened into the individual. I don't know what happened after that, after I'd spoken to the accountant, where that inquiry went, but I just thought it's something to be aware of. And if you're an accountant that kind of falls into the criteria, you might have a high number of CIS subcontractors. just make sure that you've got your audit trails in place and you've had appropriate discussions with your clients about it. Okay. HMRC activity in general, obviously there was a lot of a freeze. There was a freeze on a lot of the business as usual inquiry work because of COVID. But in the last month or so, we're seeing momentum picking up again on existing inquiries. The officers are now resuming their normal duties after being reassigned. And this is kind of reflected in what our claims department are seeing in terms of budget requests through fee requests. But we're still seeing few Section 9A inquiries opening because HMRC are now favouring the one-to-many approach. So they're the sort of letters that are coming in now. And they, on claims department, they're seeing letters in relation to the COVID grants, higher income benefit charge and student loan repayments. All the other types of nudge letters are a bit too early on at the moment to actually escalate for assistance, but I'm sure we'll see more of those later on. There does seem to be a lot of pre-cred repayment checks happening at the moment. Okay, so the one-to-many letters. So if I give you, as quick as I can, a brief overview of, I think there's about a dozen of them at the moment, set aside the COVID ones and the higher income benefit charge, that sort of thing. Most of these letters were issued in October and November by wealthy and mid-size. First one, investment income from financial institutions. So that would be the Section 17 interest data. They're looking at discrepancies in 18-19 tax returns. Benefits in kind, they're profiled by mismatched data from employer declarations and individuals' self-assessments.
Can I just say there, Zoe, I presume that mismatch is when clients don't put them in the same boxes as on the P11D, yeah?
Yeah, well, yeah, they'll be comparing the self-assessment to the P11D and yeah. And the paying tax discrepancies, there's one working on a similar basis. They've identified discrepancies from comparing the 18-19 tax return to the employer information. Annual tax on enveloped dwellings, the 8-head non-filers. They've identified corporates who appear to have purchased residential property over 500,000 from the 1st of April 20 and have not filed a return. The aim is to raise awareness. Capital gains disposals, property disposals. This is wealthy and mid-sized, but also individual and small business compliance are looking at this. It's disposal of residential property that's not a primary residence. There's two versions of the letter, one for self-assessment filers and the other for non-filers. The letters were planned from the 13th of October onwards, and there's a potential second batch from the 1st of February until the end of March, a maximum of 14,000 letters in total. There were previous letters issued in 2018 and 2019, and 15% of customers corrected their returns as a consequence. The next one is foreign tax credit relief. That's to educate about eligibility for claiming credit against employment income. Next one is overseas workday relief. That's to people who claimed relief on their 18-19 tax return. There's a residency one, people who made a claim under a double taxation agreement for 18-19 to help them correctly claim on their 19-20 tax return. Deemed domicile, aimed at people who have become deemed domicile for tax purposes under the new legislation introduced by the Finance Act 2017. And this letter will remind them to declare all the worldwide income and gains unless they have a specific exemption. There's one on the statutory residence test to help individuals to declare the correct residence position on the 19-20 tax return. There's one on person of significant control. The letters will not suggest that customers done anything wrong, but will highlight common errors and invite them to review their tax affairs. People who have not registered for self-assessment, the letter asks them to consider if they need to do so. And then there's deferred consideration to people who have disposed of shares in an unlisted company with a deferred consideration. The letter does not suggest any errors have been identified and is designed for prompt action before 1920 return is submitted. I'm sure there's some others that I've missed, and because it's early days yet with those, a number of those will obviously convert to formal compliance checks where HMRC don't get any kind of response to those. They've updated the compliance handbook at CG 600,000 onwards for the one-to-many approach. We'd advise individuals and their agents who do receive any letters not to ignore them, even if they think there's nothing to declare. It's a good opportunity to have discussions with clients to review the financial affairs and identify any obligations that haven't been met. We frequently speak to agents whose clients don't know why they've had these letters, and we found just having a general discussion with them helps to jog someone's memory that they've had involvement, for example, with some sort of investment fund or offshore account that's rarely used, or maybe have sold a residential property that they thought they were entitled to private residence relief on and perhaps weren't. So I've also found that making telephone contact with the compliance team dealing with the project can sometimes be useful. The offshore disclosure team, for example, they're quite helpful over the telephone, and they will often signpost you
Zoe,
to.
that's interesting you say that, because I had an accountant on the phone last week, and they got this letter, and because I've been around a long time, I'm always a bit reluctant to come over too knowledgeable when I ring the revenue. But this accountant rang them about a non-disclosure for potential offshore issues for 1819. And this tax officer told her everything, the accountant. So at least the risk to that, though, is that the accountant will only ask the client about that one aspect and there's something else. So I did say you do need I wouldn't tell the clients at this point exactly what the tax inspector told her, and see what was forthcoming. As it was, he says, oh yeah, I've got this sort of unit trust offshore retirement plan in Jersey. And that's clearly what the information was. And it matched up with what this revenue officer had shared. So yeah, I'm with you on that one completely.
It's an opportunity to have a general discussion and to try and figure out what HMRC are getting at. Just review everything. We wouldn't usually recommend signing the declarations that they ask you to, but if you need to write a separate letter, maybe explaining the circumstances, and if you don't, why you think there isn't any liability to disclose, but don't ignore it, because that will invite HMRC to escalate to more formal inquiry type contact if it's ignored. So yeah, it's a good idea to raise your clients' awareness generally about these nudge letters, just for them to reevaluate their situation and make sure that they're not going to be caught with any of these. So one of the things that I'm particularly interested in moving on now is Airbnb data, and I noticed that HMRC have identified property income as a reason for an increase in the number of people in self-assessment generally, and this is largely attributable to the convenience of the Airbnb platform. There's an increase in the number of people who do register for self-assessment, but HMRC will be on the lookout for the people that don't. Airbnb have provided data to HMRC for 2017-18 and 2018-19, and they'll be working through this and contacting taxpayers where there's a discrepancy in their declarations, or where they haven't declared anything at all. I suspect this will be a one-to-many approach as well. Less active renters will have less to worry about if the income was below 1,000, or if they qualify for rent a room, which is income below 7,500, although HMRC is still going to contact those people who do qualify for rent a room, and they'd have to answer questions to confirm they're entitled to the exemption.
Can I just say, Zoe, yeah, that exemption, because on rent a room, they've made a big thing of it ever since they increased the figure. And they've tightened the definition in a way, haven't they? Because what they're saying, and I'm old, I remember when John Major was the Chancellor of the Exchequer and introduced this, and he used the analogy of Tony Hancock living in a bedsit in a house run by a widow. And in reality, that's always how I've seen it. But over the years, people have stretched it to say, oh, well, it's, you know, it's if you're just renting a room out. But they now, am I right? They do make it clear now that you do have to be, you have to live in the house as much as the person who's renting the room. Am I right? Yeah. Okay. So just take that on board, people.
Yeah. Renters, get your tax affairs in order before HMRC contact you. That will be under the Let Property campaign. So potential penalties for voluntary disclosures will be significantly lower. There's no information on the number of people they may be contacting. I think this is going to be an ongoing rolling programme. So accountants could probably ask standard questions of all their clients every year, just to check that they've not recently started letting out some either a holiday home or a room in their house, including anything through Airbnb. Many people haven't considered the implications, particularly if they're new to being a landlord, because the Airbnb platform is so convenient to use. A lot of people may not have even considered. The income can be declared by making a digital disclosure or or by amending the in-date tax returns. Okay. Now moving on to higher income benefit charge. I'm particularly interested in this as well. We have a significant number of calls on our tax advice line and see nudge letters from HMRC about this. And they're still coming in as well, the nudge letters. There's increasing numbers of first-tier tribunal cases about penalties focusing on reasonable excuse. And accountants are seeing new clients approach them for assistance, and they're uncertain about the extent to which HMRC can impose assessments and penalties. So I've been looking at it from a discovery assessment point of view, because HMRC are often issuing backdated assessments to 2012-13, which is when people first came liable to the charge. So I wanted to raise awareness really that there's some contention about whether or not Section 29 Taxes Management Act 1970 provides a statutory basis for HMRC to assess the higher income benefit charge. There's a significant case in 2020, the Wilkes case. The first tier tribunal decided that the higher income child benefit charge was not income and did not amount to an insufficiency of tax because it was a standalone charge. It was also discussed in another case, I think it was Robertson, but that was primarily looking at the penalties, but they did discuss the use of Section 29. I think that one went to upper tribunal, but they did the upper tribunal didn't consider the assessment aspect of it, so that wasn't really helpful. I've got two clients where I've helped them push back on this basis, one of which HMRC did give up on the first challenge, but the other, they did accept reasonable excuse and cancelled earlier year assessments under the extended time limits. They've stood by in the assessments raised under normal time limits. They did quote some tax cases in their favour because there have been some tribunal cases where it was decided that Section 29 did provide a statutory basis, but there's ones that have gone the other way as well, particularly Wilkes. They push back on Wilkes because that's going to upper tribunal when it's listed in March. So I'm going to stand behind the Wilkes case on the client that I'm dealing with at the moment and see where that goes. Just as a side note, in case you're not aware, Section 118 Taxes Management Act 1970 provides that if there's a reasonable excuse, a person is not treated as having failed to do something, in this case a failure to notify self-assessment. This means that assessments will be limited to normal time limits. So if you've got any of those come forward, any clients, probably new clients with letters from HMRC about the higher income benefit charge, it's probably worth considering a challenge until the position has been decided at upper tribunal. So so I'm going to finish now by just giving running through the COVID grant schemes at the moment. Including the Eat Out to Help Out scheme, compliance activities still in the early stages, and though HMRC have been quickly acting where they suspect there's criminal behaviour. I probably don't need to tell you that HMRC were given new powers in the Schedule 16 of the Finance Act to tackle the compliance issues with the COVID grants, and penalties for failure to notify will be charged under Schedule 41. So the Eat Out to Help Out scheme, they've started the compliance checks and have already made some arrests relating to that fraudulent claims. They're using the one-to-many approach, and according to the Treasury, 84,700 food and drink establishments used the scheme. At the end of August, there were 130,000 claims costing £522 million. Eligible businesses had to be registered with the local authority by the 7th of July. Post-payment checks are now underway, and 4,000 letters have been sent to businesses where HMRC think there may be an incorrect claim. They're given 60 days to respond or face a formal inquiry. The criteria that they're using to risk assess, they're looking at where there's multiple claims, whether or not they're consistent with each other, the amounts claimed. People may have not met the eligibility by not registering with the local authority. The claims might not be consistent with merchant acquirer credit card payments, the data that HMRC can get quite frequently, or they might have also looked at the VAT returns submitted by the business and felt that the claims weren't consistent with those either. Voluntary disclosure will not attract penalties within the notification period, which I believe will be running out pretty soon, because it's the notification period ends 90 days after the receipt of overpayment. There's a fact sheet, FS58, about that scheme. And there's a digital disclosure facility. It's called Repay Eat Out to Help Out scheme payments. That's how you do that. Okay, the CJRS, the COVID Job Retention Scheme, it's been extended until March 21, but the government will be reviewing this in January. The government will pay 80% of wages for hours not worked, up to a cap of £2,500. The employers will pay employer NICs and pension contributions. Claims can only be made where the furloughed employees were employed on the payroll on the 30th of October 2020. The cut-off date for November claims was the 14th of December, but employers can amend a claim up to the 29th of December if they need to increase it. The cut-off date for December claims is the 14th of January 2021. HMRC may accept late claims if there is a reasonable excuse. So businesses must keep supporting documents for 6 years. The National Audit Office estimated between 2 billion and 3.9 billion in relation to fraud and error, but a significant proportion of this may be genuine error. And HMRC believe that as much as 40% of claims by small businesses are fraudulent. So they've got their work cut out there.
Have you any basis of that, Zoe? Have you got any basis for that rather in the dark figure?
Yeah, it's one claim, isn't it? I don't know. I really don't know. I've not been able to find anything more than that.
Yeah. Okay.
So there's a lot for them to do if that is the case, and they're using the one-to-many letters.
Okay.
So it's really important that employers keep good records and calculations so that they can support their claims, and ignoring the letter is not wise, as HMRC will escalate it to a formal compliance activity if they've got no response. Fact sheet FS48 might be helpful. That's about receiving grants you are not entitled to.
Okay.
All right, and then finally,
that's pretty good, Zoe. Sorry to interject because I've got the other two people to do their pieces.
That's all right.
I think the overview you've given there is comprehensive, far more than I was expecting.
Okay, I was just going to talk about the self-employment grant, but that's not necessary.
Yeah. All I would say on the self-employment grant, people, please read the questions that you have to satisfy. I had an hour's conversation with someone last week and taught them out of claiming it, because I know their business intimately, and said to them, no. And they actually texted me later and said, you're right, we shouldn't. So we're not involved directly, but if you know a client and he's claiming it, thinking it's a try on, please try and talk him out of it. Right, let's move on. I think what we'll do, if we can come over to Jason now. Jason's at NORI HR, and he's going to give us a bit of an update on IR35 issues. As people know, from the 6th of April, there will be a change for off-payroll working in the private sector. Sorry to be a pain, Jason, but if we can keep it to 20 minutes, that would be marvellous.
Be surprised if I make it 20 minutes at all, so I'll save you some time, Alan, don't worry.
All right.
Nice to meet everyone. So as Alan said, I'm going to be talking about IR35, but not directly about IR35, more the HR and employment law implications that if an individual is found to be off payroll. So obviously with IR35 and the HMRC do their assessments on the level of control is to determine whether an individual there should be some form of employment status in that aspect. So when we look at the Employment Rights Act, one of the key definitions of a worker is the requirement for personal services. Now, obviously, there are a lot more in-depth analysis that is needed when it comes to establishing someone's worker status, whether they're an employee or a worker, but that is a good telltale sign of whether that is the case. Obviously, from IR35 purposes, one of the prominent cases of Larry and Kelly and Eamon Holmes showed that just because there is a requirement for personal services doesn't necessarily mean that someone is going to be a worker or an employee in that case. So when a company or when a firm is looking at the employment status of an individual, especially when we start approaching April time and they're looking at all the contractors and self-employed individuals that they have on their books, that's going to be one of the key questions. That in essence can solve between 90 and 95% of the queries in regards to employment status. Not all, because there are certain times where there is a requirement for personal services, but the level of control is so minimal that the individual won't be classified as a worker. So situations where there's a legal requirement for that person provided. So if they're regulated by, for example, the FCA, the SRA, any of those regulatory bodies, where it's a requirement that that individual has to carry out the work. So it doesn't exclude the person providing that personal services. The implications from a HR point of view, if an individual decides then to follow up or challenge their employment status under IR35 or through a tribunal, is far-reaching for an organization. So I generally, when advising clients, refer to the Sash Window Workshop and Other versus King. Now, this was a case that was handed down back in 2017 by the European Court of Justice. It revolved around a sales individual who had 13 years with an organization, and at the age of 65, because the organization was under the belief that he was under a contract for services rather than a contract of services, they terminated the contract in line with the termination clauses that were in there, believing wrongly that it was a commercial relationship. Mr. King decided to challenge that basis and went on the grounds of age discrimination and 13 years of unpaid holiday pay. And he won. And the ricochets for the holiday pay is that it differed from previous judgments under the European directive for the length of time that someone can claim annual leave. So under a different case, Plum versus Duncan Print Group Limited, it was restricted under the European directive that someone on long-term sickness could only reclaim 18 months of annual leave. And that was at the 4 weeks, not at the 5.6 weeks that we have in the UK. So that did put a good bit of barrier on it, but the ECJ judgment in the King case opened that wide up, because the responsibility is on the firm, the businesses, to get the employment status correct from the first instance, or they face these ramifications. The same goes with other elements. If the employment status is deemed to be wrong from the offset, or it's changed halfway through the relationship. So you've got elements such as the Employment Rights Act, Section 1 or Section 4, if the individual hasn't been given the correct particulars of employment. The ramifications for businesses under that is that they could potentially face a piggyback claim of 2 or 4 weeks' pay. Now, I say it's a piggyback claim because an individual can't just take a claim forward to AIRCAS and Employment Tribunal just for not receiving particulars of employment or the correct particulars of employment. So under the Good Work Plan, there's now statutory information that must be provided within contracts of employment. The other element is if an individual has been on this self-employed or a contracted basis for more than 2 years service and the company decides to terminate it, if it's deemed that they are an employee specifically, then there's a potential unfair and wrongful dismissal claims. There's not so much of a risk for a worker under those claims, because the requirement is that they need to be an employee in order to take an unfair dismissal claim. Worker arrangements are different and viewed differently by employment tribunals and employment law. Then, like in the King case, there is the potential for discrimination claims. So in that case, he reached the age of 65, the firm decided they're going to cut ties for whatever reasons they deemed, but the courts decided it was because of the age. But in this instance, that is a risk as well. If a firm decides, well, you've reached a certain age, we're going to go with a different consultant or a different contractor, those are the elements that can be found against you. And from when carrying out assessments, you've got to look at the level of control that the firm has over the individuals. So what is their day-to-day activities? Are they required to wear a uniform? Do they report into a specific manager? As we touched on, the requirement for personal services. These are all elements that should be explored, and obviously the implications explained then to firms if they get it wrong, or if they decide to go down a different route of the long-term implications, because there's no cap anymore on the annual leave that can be reclaimed by an individual if the relationship sours 10, 15, 20 years down the line. The individual can back claim everything that was owed, because the onus is on the employer and the firm to get the relationship right. So from the implications of HR and employment law, those are some of the basics. Every scenario is going to be unique. They're going to throw up their own challenges. They're going to throw up their own individual quirks or risks involved, depending on the circumstances, whether it's a discrimination claim because of age, whether it's because a contractor has been on long-term sick and the company decides to cut ties without going down a medical capability route. We could throw 101 scenarios, but the onus now with those cases being put on the firm to get it right from day dot, and obviously with the IR35 becoming quite prominent and going to be rolled out in April, there is a lot of pressure, especially on certain industries where they need to start getting that employment status right and assessed. And from my perspective, Alan, I know you said to try and go on for 20 minutes, but without actually delving into IR35 and the two cases of Lorraine Kelly and Eamon Holmes directly, I assume a lot of people will have read up, and that's the implications.
Yeah, I think the point here is that I've said this many times at the tax clubs over the last couple of years, so if you can join in with me on this, Jason, as appropriate. I think the issue is every case is looked at in its own circumstance. And too often I've wheeled out cases, be it the legend that is Lorraine, or the slightly less legend Eamon, and what have you. And those particular cases, an example, were found on their own merits, yeah? I
right.
remember a case you've mentioned just before about wear uniforms, and there was a case I think I remembered, was it Castle Construction somewhere in Yorkshire, where even though the workers had high vis jackets with Castle Construction on the back, they had to buy them. The reason they had to have the word Castle Construction on their backs was for health and safety, because they would know that they were under the umbrella of Castle Construction. At the time, I thought, surely that if they're under that umbrella, that means they're insured and everything else. But at the time, I think it was a first-tier tribunal decision that went in favour of the self-employed people, because they were paying for these high vis jackets themselves, and it turned virtually on that one thing. It just shows you how it can be.
It is, and I think just because someone's wearing a uniform of an organization isn't indicative of them being employed by that organization. You know, I touched on the element of whether there's a legal requirement for the individual, for example, in this case, having to wear a high vis for health and safety reasons so that they know which umbrella it falls under. That would be, you'd have to follow up more questions in that individual case to assess the level of control that the firm has over those individuals, if any, in that case, bar them wearing the uniform for health and safety reasons. So yeah, every case, you can't just take a blanket approach to every single case, because no two cases are the same. You know, I have to do assessments for some clients. There was one the other day we were doing, and it turns out the individual was paramount to a virtual assistant, but the company was under the belief that they were an administration assistant and should have been employed, but actually going through the level of control, the assessments, how the work is undertaken, who they report into, there was so little control on this individual that there's literally no difference to them, the virtual assistant, being given a project. And that's where it can vary and get confusing, is when you think, well, someone's doing administration work, so, and they're doing it a couple of days a week, so they must be employed. That's not always the case.
Yeah, it's the only good news in the IR35 field, as I see it at the present time, is that they have said, excuse me, HMRC are saying that provided you've considered the issues in prior periods, if you choose to make those people next year effectively on the payroll, they won't look at the back years. And I suppose all of us in the industry, the tax and accountancy industry, can take some comfort from that. And really, they want to draw a line under it. They're just hoping and praying that the big organizations that are actively involved in recruitment of personal service company contractors particularly will toe the line in a similar way in which the public sector did, yeah? And if they do, they will see it as a resounding success, leave alone a lot of our clients where people are still using their own personal service companies, and the problem is still with the personal service company. Now, if the big boys get it right, or the revenue believe they've got it right, what small number of investigators they've had historically dealing with IR35 will mean they can actually transfer their skill sets to picking up some of these in these smaller organizations. And despite what people say, there are a lot of people out there who get bad advice, where clearly the personal service company should have had IR35 regulations applied to it and haven't. And why? And I'm not suggesting any of the 80 odd people who are listening in there are in this grouping, but there are people, practitioners, accountants, tax advisors who will have worked on the logic. The chance of getting picked up by the revenue is about as much chance of Man United winning the league this year. None.
That is the case, but I wonder, it'll be interesting to see as individuals are potentially shifted from personal service companies, whether they start claiming the back pay of holidays, whether they proactively go after that through employment tribunals. And that's something I'm warning my clients of now that are making the proactive approach of switching them and putting them on payroll is be ready for this. Because if you're changing someone from self-employed where they're doing their own assessment to putting them on payroll where they're having to pay tax and national insurance, and nothing changes fundamentally from day one to day two, the person's going to turn around and say, well, actually, I should have been a worker all along then, and I should have been paid all of this. Obviously, the long-term implications if an individual takes a claim to the employment tribunal for the back pay holiday pay is then the tribunals could notify the tax courts and the HMRC that these individuals were employed all of this time and there's outstanding tax and NI.
I am sure you're right there, that there is someone who will be patrolling, perusing the leading cases in some of these to seeing whether or not they can write to them and say, we see you, employee X has proven such and such. Can we have a chat with you, please? And before you know where you are, there will be big risks. So, yeah. Okay, well, thanks for that, Jason. I want a couple of things just to chat generally. If Ella wants to mute Jason, that would be brilliant. Now, something that is close to my heart, and this is something that I've worried about for some years. And for those who take an interest in tax cases, this is a case of Unwin versus HMRC, and the tax case number is 07837, and it was heard back in September. I think got published probably very early November. And this is where a company, an employer, an agency failed to pay over the national insurance and PAYE, and then what's the technical term? They bumped the company. Okay. And I'm not going to bore you with the ins and outs of it because time's quite precious today and I still want Rob to speak. But basically, they issued to this director a personal liability notice saying that as the company had failed to pay the NICs and the failure appeared to be attributable to fraud or neglect on the part of one or more individuals who at the time of the fraud or neglect were officers of the company. Now, I am, people who know me well, people who've listened to me over years know I'm not the biggest fan of HMRC, but equally, I do not like situations where people have a total disregard to the rules. And the rules very simply are, you deduct from someone's wages, PAYE and employees' national insurance and levy the employer's national insurance. You then, having made those deductions, you should hand it over to the revenue. If you don't hand it over and are effectively running a business on that overdraft and maybe tottering on insolvency, and not taking advice about the future of the company until some nasty letter comes from HMRC saying we're going to wind you up, then there is consequences from that, either ignorance or blatant failure to make payments to HMRC. More and more, the revenue HMRC as is are taking the time and effort to look at these cases. Probably over the last 4 years, I average maybe one a year of these types of cases. The people I meet on the other side of the table, i.e. the individual who's been served or been threatened with a personal liability notice, spends a lot of time explaining to me why it's unfair. And I always say to them, let me now go away if you'll agree a fee, and I will investigate it myself and then put together a defence, as indeed a solicitor would, to attempt for it to be airbrushed away. And I'll be very blunt with people out there. Out of the 4 cases I've done in the last 3.5, 4 years, I've only won one. I've won one partially. The other 2, albeit I put a spirited effort in, I failed. And was the revenue right to say, go away, Mr. McCann, we're going to put these notices on these individuals? Probably, because in one example, the company that was not paying its pay-as-you-earn was lending money to a family member's company to keep them solvent. And there was no intention, probably within the family, that those monies would ever get repaid. So in those circumstances, consequences come. And too often what then happens is that when the personal liability notice is served, they probably are potentially up for doing an IVA or even personal bankruptcy. Now, one final other case I just wanted to go through before I pass over to Rob. This is a case of Wilson versus HMRC, and this is tax case 7716. To me, this is ludicrous. There was a gentleman, W, Mr. Wilson, and he was a member of an LLP. We know what an LLP is. It's a limited liability partnership created probably upwards of 20 years ago, partially to protect the legal profession, taken up by the accountancy profession to give partners limited liability. The deal is that you are a member, in old jargon, a partner. You're therefore taxed if you meet all the relevant criteria as self-employed, and you have your tax bills to pay. In a well-run LLP, you would hope that provision is made within the drawings account, the capital account, to ring fence the tax liabilities. I deal with some legal partnerships where there's 20, 30 members, and we every year, I can't remember exactly, we give them an updated likely amount of tax that each partner member is going to have to pay. And that money is ring fenced, and then the tax gets paid by the partnership, the LLP. Now, this guy, Mr. Wilson, argued that despite him being a member of the LLP, his earnings were those as an employee. And he laid out all these reasons. Now, he's probably done his long-term involvement with this particular business a lot of damage, because he said, well, I'm not really actively involved in the business, which actually, to be a member, you've got to be. So anyway, whether or not they look at the LLP in more detail as a result of this case, I don't know. But the key here is that Section 863 of ITOIA 2005 tells us all activities of an LLP were treated as carried on in partnership by its members, and anything done by the LLP was treated as done by the members as partners. Mr. Wilson said his membership of the partnership was hollowed out and had no real substance. Anyway, the bottom line is, based on that ribbon of statement in Section 863, he lost his appeal. Probably correctly losing it. I'm guessing, and it is only a guess, that maybe he didn't have the money to pay his tax and thought, as a large number of self-employed people attempt to do, and this will be back to something Jason said a moment ago, that I come across quite often people who've been self-employed for years, and when they get tax bills or they decide to get their affairs up to date, they go and see an accountant who says, you know, I don't think you're self-employed. I think you're an employee. Let's fill your tax return out as an employee and see what happens. Excuse me. They open an inquiry into that personal return. The case is put forward. And as a result of that, HMRC are obligated then to discuss with the so-called employer his status. If the case is clear that he was a disguised employee, then yes, that accountant may have been very clever and absolved the individual of having to pay his own taxes. Sorry, the self-employed person or the formerly self-employed person. but too often it's a try on. And with Mr. Wilson, I suspect maybe there was a bit of a try on. He thought, I don't really do anything in this business other than being like a hired hand. So why should I pay the tax? Maybe the background to that, as I said a moment ago, is that he didn't have the money, but who knows? So just bear that in mind. LLP members are partners. They are self-employed. They are not employees. Okay, with that, Ella, could we now bring up the legend that is young Mr. Robert McCann? And as I say on all these occasions, young Robert, we are not related, thankfully, and I'm sure on your side you're very grateful for that. Be careful. So you're going to give us a bit of an overview of what's gone on in the exceptionally exhilarating world of VAT.
Yeah, thanks, Alan. Good afternoon, everyone. Those of you that took part in last month's session will be aware that my colleague David spent some time talking about Brexit and the impact from both the customs perspective, and also touched upon a few VAT issues as well that UK businesses will face. Now, sort of following on from that this month, I just wanted to spend some time initially just talking about changes that will potentially affect UK suppliers of both goods and services to consumers in the EU as opposed to businesses. And that's not just the impact of Brexit on the 1st of Jan, but also the potential impacts of new EU rules that will come into play with effect from 1st of July next year, that have the potential to affect UK businesses. And then once I've talked about that, there's also another couple of general points that if I get a chance and Alan doesn't cut me off, I'll run through as well. Beginning with the Brexit issues. At the moment, the general rule is that UK VAT's chargeable on most goods and services that are sold to EU consumers by UK businesses. There are certain exceptions to that, of course, as always with that. One is distance sales of goods that reach a certain threshold. So, for example, if we've got a UK supplier of goods to consumers in Germany, initially those sales attract UK VAT, but once those sales exceed a certain threshold in a year, which in Germany is €100,000, after that point in time, the UK business has no choice but to register for VAT in Germany and then subsequently declare VAT on sales made after that point in time. The other exceptions to that general rule are certain services where the place of supply is deemed to be the EU. That includes certain land-related services relating to EU land. It includes services relating to events that take place in the EU. And again, at the moment, there's no threshold, but any service that we provide to an EU consumer that falls into one of those two categories, we have no choice as a UK business to register for VAT in that particular EU member state and charge VAT at the rate applicable in that member state. Now, the other and final exception relates to electronically supplied services, where at the moment, I mean, most of you will probably know that the EU has what they call a mini one-stop shop, whereby although VAT is charged at the rate applicable in the EU member state where the consumer is located, is established, the UK business can register for VAT in one EU member state and then submits one VAT return with all the details of the EU sales, and that member state where it's registered, the UK for obviously at the moment, will then divvy up that VAT amongst the other EU member states. Now, the first change that's effective from 1st of July is that one-stop shop is being extended to other services where we have the place of supply being the EU. So if, for example, we act for a UK architect that is providing services to a private individual in relation to their French property, and also a German individual in relation to their German property, at the moment, they would have to register for VAT and charge VAT in both France, Germany, and any other EU member states that they they operate in. Whereas after 1st of July, similar to the electronic services rules now, they'll register for VAT in one EU member state. Ireland would be the obvious choice, given the sort of language similarities and the similarities between their tax regime and our own. So register for VAT in Ireland, and we would then again submit the single VAT return to the Irish authorities that would include the VAT that we've effectively collected in Germany, France, Spain, etc. Now, the other change, and fairly major change, relates to distance sales of goods. Now, as I said before, at the moment, UK VAT is due until we hit a particular threshold. Now, starting with the Brexit change, after 1st of Jan next year, any distance sales of goods from the UK to a consumer in the EU won't attract UK VAT. It'll be zero rated effectively as an export from the UK. Now, the question then, or the UK supplier then has two options really with regard to the imports of those goods into the EU. Option one is to import the goods into the EU in its own name. Now, if it does that, it has an automatic obligation to register for VAT in that EU member state. So you can imagine if it's importing goods in its own name into France, Germany, Italy, Spain, it's suddenly going to have multiple VAT registrations that really, as I say, is probably not palatable from an administrative perspective. So the other option, and the option that most businesses seem to be employing at the moment, is to have the goods imported in the name of the customer. So that removes any obligation to register for EU VAT in the country in which those goods are imported, despite irrespective of the level of sales into that country. Now, that's only part of the story though, because if no action is taken beyond that, the EU consumer would end up with a VAT bill and potentially a duty bill as well. So before the goods are released to them on the doorstep, they'll be asked to pay the VAT and duty, which obviously isn't great from our point of view, because we've sold the goods at a price, and our customer in the EU expects that to be the delivered price. So what we can do there, and what we need to do as a UK business, is speak to the courier or the shipping company, advise them that we need to meet the VAT cost. We want to meet the VAT cost of the consumer, the VAT and duty cost that the consumer faces when those goods hit the EU. And as I say, it's really important that we give them that instruction. A, the goods are imported in our name into the EU, and B, we meet the VAT and duty cost. And most certainly the large sort of courier businesses, shipping companies, are set up to deal with that type of instruction. And as I say, that's far more straightforward from our perspective, because we don't have multiple VAT registrations, and we don't have the consumer having to pay a VAT bill at the doorstep. The other key point there, though, is obviously we need to price accordingly. We need to price to reflect the fact that there'll potentially be customs duty payable at import into the EU, and also that the VAT rate might differ from one EU member state to another. Now, after 1st of July, as I said, that's the position, and that's really the route we want to go down for the first 6 months, from 1st of Jan to 30th of June. After 1st of July next year, the position changes again. And as long as the item that we're selling to the EU consumer is less than €150 in value, then there'll be no VAT at import, and there'll be no customs duty. However, that will be payable or declarable at the local rate on the sale to the consumer. So if there's a sale to a French consumer of an item that's €140 in value, no VAT at import, but VAT is due at the French rate on the sale to the consumer. Now, if that sale of goods is made via a platform or marketplace, Amazon would be the obvious example, then it's generally speaking Amazon's responsibility after 1st of July to declare and collect the VAT that's due, again at the local rate. So as a supplier, as a UK supplier, we don't have any obligations in that regard. However, we need to bear in mind that Amazon will be deducting the VAT and paying that over to the relevant authorities from the amount that they receive from the consumer, and we'll only get the balance. So again, when we price, we need to bear that in mind. Now, the responsibility to pay and declare the VAT passing to the marketplace or platform applies to all goods under 150 euros, as I said, and it also applies to goods that are of any value that are held in the EU for fulfillment or to fulfill sales that are made to that particular EU member state. So if, for example, goods are held in an Amazon fulfillment center, for example, in Germany, whatever the value of those goods, it's Amazon's responsibility to declare the VAT on the sale of those goods to the consumer in the EU. Now, if we sell the goods from our own website, say, or if an EU business sells goods from its own website or makes a sale that doesn't involve a platform or marketplace, the same rules apply in terms of import VAT and duty, so there'll be no import VAT, no duty. However, again, VAT is due on the sale to the consumer, again at the rate that applies in the country where that consumer is accepting delivery of those goods. Now, in that case, as I said right back at the start, at the moment, when we exceed the distance sales threshold, we have to register for VAT in each EU member state. After 1st of July, that won't be necessary. There'll be, similar to the one-stop shop for services, there'll be the introduction of an import one-stop shop, where we'll be able to register for VAT in one EU member state. Again, Ireland is the obvious choice. And then, although we're charging VAT to French consumers at French rate, charging VAT to German customers at the German rate, we'll be collecting that VAT, paying it over on one return via one payment to the authorities in the EU member state that we decide to register in. So far simpler than the process, than arguably simpler than the distance selling process now, and maybe creates more certainty than the position we're in the first 6 months after Brexit, after 1st of Jan. Now, if as a UK business we fail to register, we fail to register for that one-stop shop in the EU, then the default position will be that the customer will pay the VAT, and well, so there'll be no customs duty. We'll pay the VAT at the point of receipt of the goods, which again we want to avoid if at all possible. Now, I've covered a fairly large, fairly complex issue in a fairly short space of time there. So there are, if there are any sort of particular client issues that you want to talk about afterwards, then by all means get in touch. But I suppose the main point there, for any distance sales of goods and services to EU consumers, is that they need to be carefully considering the VAT impact of their trade, both 1st of Jan onwards and 1st of July onwards, to reflect those changes that we discussed. Now, moving on, one other point on Brexit. I think last time we spoke, David will have mentioned the change in the import VAT position for UK VAT registered businesses. In the import VAT will no longer be payable at the border. It will be payable on the VAT returns, declared on the VAT returns via a system of what HMRC described as postponed VAT accounting. Now, since last month, HMRC have advised that businesses will be able to download import VAT statements in the first half of each month relating to the previous month, that will contain details of the importations and of the VAT on those importations that they need to declare on the VAT return. Now, in the last few days, HMRC have also announced that businesses will be able to sign up for those statements, to receive those statements via their sort of usual government gateway password. And it's obviously important that prior to the end of December, that affected businesses that will be importing goods into the UK that are VAT registered here go through that sign-up process and make sure that they're in a position to receive those statements after the 1st of Jan. Now, thankfully, probably from your perspective, moving on from Brexit, one or two other points that have arisen in the last month that I just want to touch upon. The first relates to VAT that was deferred due to the coronavirus. You'll no doubt be aware that businesses with a VAT bill arising between 31st of March and the end of June this year had the option of deferring that VAT until 31st of March this year, next year, I should say. Now, HMRC have now said that those businesses will have two options in terms of paying that VAT off. They can either pay that VAT in full, the deferred VAT in full, by 31st of March 2021, or they can pay via 11 equal monthly instalments from, well, effectively April 21 up until March 2022.
Can I just say, Rob, if we took a vote on that, I can suggest which one most people will go for.
Absolutely, I wholly agree. And those businesses that will go for the instalment option, they need to opt into that. So they don't just make the choice and then follow it. They actually need to opt in. Now, helpfully, of course, HMRC haven't yet told us how businesses will need to opt in. But it goes without saying that we'll all need to keep an eye out and on whatever HMRC do say in relation to that opt-in process, and make sure that affected clients do follow whatever process that might be prior to the 31st of March deadline. Now, one other, maybe two depending on time, but certainly one other point I'd like to talk about relates to...
Yeah, we're getting a bit close, Rob.
Yeah, no, this will be, 2 minutes, Alan, or...
Okay, let you have that 2 minutes. I'll count
That's
you down.
Right, thank you. Any more, by all means, cut me off. But it relates to charity advertising. And now, you may or may not be aware that there is a VAT relief, a zero rate, that applies to advertising in any medium by charities. So that might be an advert placed in a newsletter, in a newspaper, on TV if it was so grand, or on radio, any advertisement time or space that's bought in by a charity, it shouldn't pay any VAT, subject to it giving a sort of certificate of eligibility to the supplier. Now, one of the conditions of that relief is it must be targeted at the public in general, or aimed at the public in general, and not targeted at named or specific individuals. Now, because of that, HMRC have previously used that restriction to deny relief on much internet advertising and social media advertising, on the basis that it's targeted via algorithms in some way. So that would have meant VAT was charged if it was a UK supplier, or if it was a VAT registered charity receiving the service from overseas, as is often the case because Google are established in Ireland. The charity had to declare that it generally couldn't recover on a reverse charge basis for those purchases. Now, following a fair bit of lobbying by the charity tax group, HMRC now accept that much of that internet advertising can now be zero rated. And that includes adverts that are aimed at a certain demographic, adverts aimed at people living in a certain area, adverts aimed at people visited a certain website, pay-per-click adverts, and also adverts that are placed alongside specific specified content. So if any charity clients have incurred such costs in the last 4 years and paid VAT, there's the opportunity for them to contact the supplier and obtain a rebate of VAT that might have been overcharged. So that, Alan, is probably it.
Well, as always, Rob, honestly, it's a pleasure listening to you on most occasions. No, that's great. Just before everybody shoots off, because I'm conscious we've got just some very quick things I want to just cover, if that's okay. This is interesting, I think. From the 4th of April 2022, HMRC will introduce a check on tax registration known as conditionality. And it means that when some types of businesses seek to renew a license to trade, they can only obtain the license if they are able to demonstrate that they are registered for tax. Wow. This changes focus at businesses which accept, would you believe, cash payments, with the intention of helping them to understand their tax obligations and therefore increasing compliance with the annual tax return and payments process. Those affected, and this is worth noting, people, taxi and private hire vehicles, minicabs, PVH businesses, scrap metal dealers on a site, and mobile collectors of scrap metal. So let's be clear here. That man who comes round saying, have you got any old scrap, who's clearly not registered for tax, do you really think he's going to bother registering with the local council? Not sure, very unlikely. Going forward from there, in the future, when an applicant is renewing their license, the licensing body must, before considering the application, obtain confirmation from HMRC that the applicant has completed a tax check. This means that an applicant will have to provide information to HMRC to enable HMRC to satisfy itself that the applicant has complied with an obligation to notify their chargeability to tax. Is this not joined up world, hey? Interesting. So bear that in mind. If you sign up new clients in these particular industries, if they don't do their compliance, and how far the compliance will go in terms of having paid their taxes in their entirety, only time will tell, but it will be interesting. It might even lead to you getting some new clients who come up for renewal and say, I need to get my affairs up to date. Now, building on something that Rob just said, people on self-assessment, you can now do an online time to pay arrangement. And the apparently, because I'm still a person who uses the phone, but online, they can do arrangements up to £30,000, but it can only happen once the 1920 tax return has been submitted, that you put in place a direct debit, and it would be for a period not exceeding 12 months. So in a nutshell, clients must have no outstanding tax returns, no other tax debts, and no other HMRC payment plan in place. I have to say that cancels out virtually everybody I act for, but there will be occasions where people who have been compliant and are up to date just have got a problem paying their self-assessment. You should potentially grab the offer as quickly as they can. Final point. I just want to make this statement from a recent tax case, and it's about what the judge said, a tribunal judge, about taxpayers' responsibility. And what he said was, the taxpayer must check the tax return herself to make sure that it was accurate so far as she was able, taking account of her understanding and circumstances. Even if the return included complex matters, she would still be expected to check that the figures were correct. I find that worrying, because the simple thing is that quite often people use accountants and tax advisors, tax return preparers, because of the complexities of the UK tax regime. He's basically saying, the judge that is, that when you get that tax return to check in that parallel universe that none of us live in, that they should ask questions and be happy with it. In truth, conceptually, he's right, but we know it's going to be a struggle for that to happen. But just bear it in mind, if that becomes an enshrined opinion. Right, with that, we're just literally past 2 o'clock. A few people have dropped off because he knew I was going to speak. Thanks for attending. The numbers are very inspiring for both myself and Ella. I wish you all well for the slightly weird Christmas and New Year we're going to have. Also, enjoy January while you get all your tax returns done. Don't ask me to help you because I don't do tax returns, but notwithstanding, have a great time over Christmas, New Year. And I think, Ella, you would tell me that the next one will probably be towards the end of February, possibly early March. Is that fair?
Yeah, probably.
Okay. Thank you for coming. And hopefully I will see a lot more of you in person next year. Bye for now.
Thank you very much, everyone. And thank you to the speakers as well. I hope that you all found it useful. And if you have any questions, please feel free to let us know via email. And so with that, I'm just going to say Merry Christmas and hope to see you again next year. Bye-bye.